To trade stocks, you must choose an account with a broker that fits your trading style, fund your stock account, establish clear financial goals, decide how much you can invest, and assess how much risk you can handle. One effective strategy to increase your money over time is to invest in stocks. You can learn the fundamentals of stock investing with our beginner's tutorial. Let's get started. Regardless if you have thousands saved up or you can only afford to invest $25 a week. Are you ready to master your money? Then like this video and subscribe to our channel for more weekly insights. First things first, clearly state your financial goals. You'll stay focused and make better investing selections if you have clear goals. Think on your long and short-term objectives because they will influence your approach to investing. You may have long-term goals like supporting a child's education or ensuring a comfortable retirement, or you may have short-term goals like saving for a house or a trip. Your goals are determined by your aspirations and stage of life. Investors who are closer to retirement usually prioritize capital preservation and income generation, whereas younger investors are more likely to concentrate on growth and long-term asset creation. The more accurate you can be, the better. Aim for precise objectives like accumulating $500,000 in my retirement fund by age 50, rather than general ones like save for retirement. Determine how long you have for each target. While more conservative tactics may be necessary for shorter time horizons, longer time horizons can permit more aggressive investment strategies. You won't need to be as conservative in the beginning the longer you give yourself. When determining how much you can contribute to your investment goals, take into account your normal income, savings, and any additional financial resources. Most people manage multiple goals at once, and depending on the urgency and importance, we have to prioritize things like saving for a down payment on a house, paying for a wedding next year, or getting ready for retirement. For instance, accumulating money for a down payment on a home could be a more important goal than making travel plans. It is best to think of the term financial planning as a verb rather than a noun. It's a continuous process that ought to change to meet your goals and needs. You may discover that relocating cross-country is necessary for your life's job, fall in love or out of it, and have many children or none at all. As your circumstances change, assess and modify your goals on a regular basis. If you feel ready, take notes on the topic to make the most progress. You should carefully look at your finances to figure out how much you can invest in stocks. By doing this, you can be sure that the investments you make are smart and won't put stable finances at risk. Start by making a list of all the ways you can make money. Check to see if your employer offers matching funds or tax-advantaged ways to invest to increase the amount you can put in. Make sure your money is in order before you invest. Being solid does not simply mean being flawless. It is important to have an emergency fund set up first. This fund should be enough to cover 6 months worth of big bills and costs, like rent or mortgage payments and other necessary things. In general, you should have paid off credit card balances and other loans with high interest rates. Unless it's a mortgage, paying back all debt is priority number 1. It's simply too risky to invest in the stock market when you have a chance to get a 10% return, while your credit card debt for sure will rise at 15% interest rate. Based on your analysis of your finances, figure out how much money you can safely invest in assets. As we move on to the next topic, it's crucial for my viewers to understand that while stock picking is an option, it is not the preferred strategy for us. Instead, we emphasize the importance of broad diversified index funds. These funds provide a more stable and reliable investment approach by tracking the performance of a wide range of stocks, minimizing risk associated with individual stock choices. An index fund is basically a large basket of the most valuable companies within a defined niche of the index. When you invest in an index fund, you get exposure to the entire basket of companies within that index. It's a simple and easy way to invest, providing diversification and reducing risk. Over the long term, index funds always yield the best results due to their broad market exposure and low management fees. For first-time investors, selecting the right investments can be intimidating due to the numerous options available. However, the most effective and straightforward approach is investing in index fund, as we mentioned prior. The funds are not individual stocks, but rather a collection of stocks that mirror the performance of market indexes, such as the S&P 500. Here's why they're the best option. 1 is diversification. Index funds spread your investment across many companies, reducing the risk associated with investing in individual stocks. Number 2 is its simplicity. With index funds, you don't need to pick and manage individual stocks, as investing in one index fund gives you exposure to a broad range of companies. 3 is actually cost-effective. Index funds typically have lower management fees compared to actively managed funds, making them a cost-effective investment choice. 4 is long-term performance. Historically, index funds have provided strong long-term returns, making them an ideal choice for building wealth over time. But one thing we must say is you need to avoid stock picking. Stock picking involves selecting individual stocks to invest in, which can be time-consuming and risky, especially for beginners. The complexity of analyzing companies, market conditions, and economic factors makes stock picking a daunting task. Moreover, the performance of individual stocks can be highly volatile, leading to potential losses. In contrast, index funds offer a safer, more reliable path to investing by spreading risk across a broad array of companies. By focusing on broad, diverse index funds, beginners can build a strong, stable portfolio without the complexities and risk of individual stock picking. This approach not only simplifies the investment process, but also aligns with a long-term strategy for financial growth and stability. Next, we're going to talk about risk management and investment goals. Investing is all about allocating current resources towards a future financial goal. There are varying levels of risk associated with different investment products and asset types. Index funds offer a balanced approach by mitigating the risk associated with individual stock investments. On top of that, you need to understand commissions and fees. Most brokers charge a commission for each trade. However, by investing in index funds, you can actually minimize these costs. Index funds typically have lower fees compared to other investment types, making them an efficient option for managing expenses. Even with a modest initial investment, you can start investing in index funds. It is important to understand your investment goals, risk tolerance, and the associated costs. Researching brokers and their fees will help you choose the best option for your investing style. By focusing on index funds, you can build a stable and diversified portfolio without the complexities and risk of individual stock picking. This approach simplifies the investment process and aligns with a long-term strategy for financial growth and stability. We hope you found this information useful. Like and subscribe for more finance content, and check out our video on why the first $100,000 are hard, but the next will be easy. I'll see you there.